Welcome to the first module of the ACI Dealing Certificate, Financial Markets Environment. This session will lay the foundation for your understanding of how global financial markets work, who participates in them, how they are structured, and the key regulations that govern their operations. Whether you are working in foreign exchange, money markets, or derivatives, understanding the environment in which these instruments trade is essential. Let's begin by understanding the role and definition of financial markets. Here's what we'll cover in this session. Definitions and main functions of financial markets. The role of various economic agents and market participants. A breakdown of markets, FX, money, capital, and commodities. How financial markets are segmented by maturity, product, trade, settlement dates, and regulation. Distinction between cash spot markets and derivatives. Structure of regulated and OTC markets. Role of market makers and the impact of information. Understanding the front, middle, and back office functions. Global codes of conduct like the FX Global Code and UK Money Market Code. A brief overview of financial market regulations like MiFID II, EMIR, Basel norms, and more. By the end of this session, you'll have a broad, structured view of how financial markets are organized globally. So what are financial markets? In simple terms, financial markets are platforms that bring buyers and sellers together to trade financial instruments like currencies, bonds, equities, or derivatives. They help in mobilizing savings and allocating capital, providing liquidity, facilitating risk transfer through instruments like derivatives, enabling price discovery based on supply and demand. Each market, whether FX, money, capital, or commodity, plays a unique role in the broader economic ecosystem. We'll now explore each of these in more detail. Let's begin by understanding what financial markets actually are. Financial markets are platforms, institutions, or systems that facilitate the buying and selling of financial securities and assets. They serve as the central hubs where capital moves from those who have it, like investors, to those who need it, like businesses, governments, and banks. Now, these markets are diverse and categorized by the types of assets traded. The most common segments are the foreign exchange market, where currencies are traded globally. The interest rate markets, including the money market and the bond market. The equity market, where shares of companies are bought and sold. And the commodity market, which deals in physical or financial trading of assets like gold, oil, and agricultural goods. Transactions in these markets can occur in two primary ways. Over-the-counter, or OTC, where trades are negotiated directly between two parties, usually involving banks and financial institutions. Or via exchanges, regulated platforms like stock exchanges or commodity exchanges, which provide transparency, standardization, and clearing mechanisms. Typically, equities, commodities, and standardized derivatives are traded on exchanges, whereas currencies and many fixed-income instruments are predominantly traded in OTC markets. Understanding this distinction between OTC and exchange-traded markets is critical as we explore how risk is managed, trades are settled, and regulations are applied in later modules. Continuing from the previous slide, let's now look at the core characteristics that define a well-functioning financial market. 1. Transparency. This refers to how freely and accurately information is shared among market participants. In transparent markets, price quotes, trade data, and market conditions are visible to all players, helping build trust and confidence. 2. Liquidity. Liquidity means how quickly and easily assets can be bought or sold without causing significant movement in price. For example, the foreign exchange market is extremely liquid. You can buy or sell large amounts of currency with minimal price change. 3. Efficient pricing. In robust markets, prices reflect all available information. This concept is known as the efficient market hypothesis. When pricing is efficient, assets are neither overpriced nor underpriced for long, helping investors and risk managers make informed decisions. 4. Information sharing. Access to real-time market data, news, and economic indicators allows participants to analyze risks, assess trends, and act promptly. Modern electronic platforms have made information more accessible than ever before. Now, it's also important to understand that financial markets don't operate in isolation. They function under a framework of laws, regulations, and statutory guidelines, and are supervised by the relevant national or regional authorities. For example, in India, the RBI oversees the money and FX markets, while SEBI regulates the capital markets. In the United States, it's the SEC and the Federal Reserve. In Europe, markets are regulated by institutions like the European Securities and Markets Authority, ESMA. Each asset class, whether it's FX, money market, equity, or commodities, falls under the jurisdiction of a regulator suited to its market nature. These regulatory frameworks are essential to prevent market manipulation, protect investors, maintain systemic stability, and ensure fair conduct among participants. Now let's talk about the key market participants and economic agents in financial markets, particularly in the foreign exchange, FX, market, as defined by the Bank for International Settlements, BIS, and the FX Global Code. According to the code, a market participant is not just any trader or institution. It refers to specific entities or individuals that play an active, regulated role in the buying and selling of currencies. Let's break down the official definition. 1. Active in FX markets. A market participant is any person or organization that is actively involved in the purchase or sale of one currency against another. This could include banks executing spot or forward FX trades, central banks conducting interventions, or corporates and institutions hedging their exposures. This also covers those who operate indirectly, for example, through brokers or aggregators. 2. Operating a trading platform or system. The definition also includes organizations that run the infrastructure through which FX trades occur. These are companies that operate facilities, platforms, or systems allowing other participants to execute trades. Examples include electronic communication networks, ECNs, multilateral trading facilities, MTFs, FX trading platforms like Reuters, EBS, or Bloomberg FXGeo. 3. Providing benchmark execution services. Some participants provide execution services based on FX benchmarks, like Reuters 4 PM Fix. These service providers are also covered under this definition because their pricing and timing are often used for index tracking, passive management, or accounting purposes. 4. Excludes retail participants. Importantly, retail participants, such as individual investors or small traders, are not considered market participants under this definition. This is because the FX Global Code is intended to apply to institutional-level trading, which has larger volumes, greater impact, and regulatory obligations. So in essence, this definition ensures that the FX Global Code applies to the right entities, those who influence the market's integrity, transparency, and functioning. These participants are expected to adhere to the principles of fair conduct, good governance, and risk control, which we'll explore more in upcoming slides. In the previous slide, we explored market participants, those who actively engage in financial markets. Now, let's take a broader view and look at economic agents, who are the key players in any economy. An economic agent is any individual, group, or organization that makes economic decisions and impacts the flow of money, goods, services, and capital in an economy. There are four primary categories of economic agents. 1. Households or individuals. These are consumers and savers. They provide labor to businesses and earn wages. They consume goods and services. They invest their savings in financial products like bank deposits, mutual funds, or even stocks. Their behavior greatly influences demand, consumption patterns, and savings rates, which in turn drive economic growth. 2. Businesses. These are the producers of goods and services. They hire labor, invest in capital, and create output. Businesses also borrow and invest in financial markets, playing a key role in capital formation. They engage in FX and derivatives markets for hedging, investment, and trade financing. Their decisions on production, pricing, investment, and hiring affect employment, inflation, and overall economic health. 3. Central banks. Central banks are powerful public institutions that manage a country's monetary policy. They control money supply, set interest rates, and manage inflation. They regulate financial institutions and ensure systemic stability. In FX markets, they may intervene to stabilize currency values. Examples include the RBI, Federal Reserve, ECB, and Bank of England. 4. Governments. Governments influence the economy through fiscal policy, taxation, and public spending. They may borrow in capital markets, issue bonds, and run deficits or surpluses. Their policy decisions affect demand, economic growth, and investment climate. They also play a regulatory role by framing economic laws and supervising sectors. As we commence this session on Financial Markets Environment, Part 2, let's quickly understand what we will discuss today. We begin by understanding the key phases of financial markets and the crucial distinction between the roles of the front office, middle office, and back office. Knowing who does what, from trading and dealing to risk management and settlements, is fundamental to managing operations effectively and avoiding failures. We then look at global codes of conduct, including the FX Global Code, Global Precious Metals Code, and the UK Money Market Code, all of which aim to bring transparency, integrity, and trust to the way markets function. Our discussion will then touch upon regulatory frameworks such as MiFID II and MiFIR, which have reshaped trading transparency and investor protection across European markets. We also examine the Market Abuse Regulation, MAR, and Benchmark Regulation, both critical in preventing manipulation and ensuring the accuracy of market benchmarks. On the infrastructure side, we shall also discuss EMIR, European Markets Infrastructure Regulation, designed to regulate OTC derivatives and improve systemic risk control. And from the US side, we explored the Dodd-Frank Act and the Volcker Rule, which redefined risk-taking boundaries for major financial institutions post-2008. Finally, we wrap up with the Basel Accords, Basel I, II, and III, the global standards for capital adequacy, liquidity, and banking supervision, aimed at making banks more resilient in a volatile financial world. Welcome to Part 2 of the Financial Markets Environment. In this section, let's begin by understanding the four key phases that most financial markets cycle through. These phases reflect the psychological behavior of participants and the structural movements in the markets over time. 1. Accumulation phase. This is typically the phase after a market has bottomed out following a decline or a crash. Prices have stabilized, and pessimism dominates the headlines. However, smart investors, often early adopters and contrarians, begin to quietly accumulate assets. They recognize undervaluation and start building positions before the broader public sees the opportunity. 2. Markup phase. As accumulation builds up, prices start to rise gradually. Eventually, this attracts the attention of the general investing public. More participants jump in, pushing prices higher. This is when the majority of market participants join, driven by optimism and fear of missing out. Interestingly, smart money starts exiting during this phase, taking profits. 3. Distribution phase. Now the market has gained significantly. Sentiment becomes mixed to slightly bearish. Prices start to move sideways or become choppy, indicating uncertainty. This is where sellers begin to dominate, especially those who bought early. It's a sign of the rally nearing its end. Institutions often offload holdings during this phase. 4. Markdown phase. The inevitable decline begins. Prices fall, and pessimism returns. Laggards who entered late during the peak now try to exit, often at a loss. Panic selling is common. Meanwhile, early adopters and smart investors begin scanning for new bottoms, preparing to repeat the cycle by re-entering in the next accumulation phase. This cyclical structure, accumulation, markup, distribution, and markdown, is observed in equities, commodities, and other financial markets. Understanding these patterns helps in strategic decision-making for both traders and institutional investors. In today's highly interconnected and fast-moving global financial system, codes of conduct and regulatory frameworks play a crucial role in maintaining market integrity, transparency, and trust. Let's begin with the 3 major voluntary codes that govern behavior in key financial market segments. First, the FX Global Code. This is a set of principles designed to promote a robust, fair, liquid, open, and appropriately transparent foreign exchange market. It applies to all market participants, including banks, central banks, asset managers, and corporations, and outlines best practices across ethics, governance, execution, and risk management. Second, we have the Global Precious Metals Code, which provides guidance for market participants in the bullion markets. It aligns closely with the FX Global Code and ensures responsible behavior in trading gold, silver, platinum, and palladium. Finally, the UK Money Markets Code. This governs conduct in the unsecured deposit, repo, and securities lending markets in the United Kingdom. It emphasizes the importance of fair and effective markets, sound risk management, and appropriate governance structures. These codes are not legal mandates, but adherence to them is seen as a mark of professionalism and is increasingly expected by regulators and counterparties alike. In addition to voluntary codes of conduct, the global financial markets are shaped by a robust set of binding regulations, especially in the European Union. Let's walk through some of the key ones. MiFID II Markets in Financial Instruments Directive 2. This is a cornerstone regulation that governs investment services and trading venues in the EU. It aims to increase transparency across markets, improve investor protection, and move trading onto regulated platforms. It applies to equities, bonds, derivatives, and other financial instruments. MiFIR Markets in Financial Instruments Regulation. MiFIR complements MiFID II and is directly applicable across EU member states. While MiFID is a directive requiring national implementation, MiFIR ensures consistent rules on trade transparency and reporting, especially for investment firms and trading venues. EMIR European Market Infrastructure Regulation. EMIR was introduced to improve transparency and reduce systemic risk in the over-the-counter (OTC) derivatives market. It mandates central clearing for standardized derivatives, timely trade reporting, and risk mitigation measures for non-cleared contracts. Benchmarks Regulation. This regulation ensures the accuracy and integrity of benchmarks used in financial instruments and contracts, such as LIBOR or Euribor. It addresses the risk of manipulation and strengthens governance and transparency of benchmark setting processes. Market Abuse Regulation, MAR. MAR strengthens the EU's framework against insider trading and market manipulation. It introduces stricter disclosure rules and wider enforcement powers to protect market integrity and ensure a level playing field. Together, These regulations build the legal backbone of the European financial ecosystem, ensuring stability, fairness, and investor confidence. The FX Global Code defines a market participant as any person or organization, regardless of legal form, that meets any of the following criteria. 1. Actively engages in the FX markets as a regular part of its business. 2. Operates a facility, system, or platform through which FX transactions can be executed. 3. Provides FX benchmark execution services. And 4. Is not considered a retail market participant in its jurisdiction. This also includes personnel acting on behalf of such entities. 2. Guide discussions. The code provides a broad classification of entities that may be considered market participants. These include financial institutions like banks and dealers, central banks and supranational or quasi-sovereign entities, asset managers, sovereign wealth funds, and insurance firms, corporate treasury departments, family offices that run treasury operations, benchmark execution providers and non-bank liquidity providers, brokers, remittance businesses, and money changers when interacting with the wholesale FX market, FX electronic trading platforms, and platforms involved in affirmation and settlement processes. In essence, any entity engaging with the FX wholesale market in a professional capacity may fall under this definition.